Welcome to The Grasp. I'm Doug Werlin, and today we're going to be talking about cryptocurrency and why it should be a part of your portfolio. We'll be looking at all the asset classes, what are the advantages and risks associated with each asset class, and why cryptocurrency is such a strong contender for your portfolio. Before we begin, we have to give the legal disclaimer. We are not professional financial advisors. Anything that we say here is for educational and entertainment purposes only. Please do your own research. So why invest in crypto? That's a question lots of people are asking, and we want to cover that today because there are a lot of investment vehicles, right? And you're familiar with a lot of these. There's obviously real estate. People have heard of stocks and bonds, obviously cash, and any type of instrument related to those things. So we want to cover why should crypto be a part of your investment portfolio? What do we need to know about the advantages and disadvantages of each of those asset classes and how it applies to you? So everybody has different goals in their investments. Not everybody's in the same place in life. Not everybody wants the same thing, and what your specific goals are is going to greatly influence what type of vehicles you're interested in investing in. For instance, an 80-year-old is in a completely different life position than somebody that's 20, and their goals and their vehicles are completely different. So those are the types of factors we have to consider. So are you looking for security? Are you looking for protection of your principal? Are you looking for growth? All of those things require different types of vehicles. So with that in mind, let's start taking a look at each individual vehicle and find out what are the advantages and what are the risks with each of those. So obviously the first vehicle is cash. And by cash, we mean any cash-related account. So that would include savings accounts, checking accounts, things like that. Everyone is familiar with those, and we've heard all our life that the way to wealth is to put money in the bank in a savings account. But like anything else, there are advantages and risks to that. So obviously when we're talking about the advantages of cash, it's liquid, right? It's easily exchanged for goods and services. It's portable. You can put it in your wallets, you can carry it around. So there are advantages to having cash. But there are also risks to having cash. And the problem is people don't necessarily think about those risks. So the first risk you would think about is obviously inflationary risk, right? The dollar is worth less every single day. One of the things you may not have considered are the security risk of it. So you think, well, my money's safe because I went and I put it in a bank. But there are things that have happened over the last 10, 15 years that should alarm everyone about the real safety of cash inside of a bank. For instance, there's something called cash controls. I don't know if you remember during the financial crisis several years ago, but some countries, for instance, Malta, instituted what were called cash controls. Greece, other places in the world, when the financial crisis hit. So you would deposit your money in the bank, and the bank won't let you take it out. That's a cash control. So they say you can only have $100 a day, or you can only have $200 or 200 euros or whatever the currency may be. But that's one form of risk that's associated with cash. Another form of risk associated with cash that is somewhat related to that is what we will call the reserve requirements. So whether you know this or not, every bank is required to keep a certain percentage of the total deposits in that institution in cash so that it's available to give out to its customers. Traditionally, that has been 3%. Now, 3% is alarming in and of itself. So what that means is for every $1,000 you deposit in your bank, they are required to keep 30. The rest of it they can give out and loan to other people or deposit it on deposit with the Federal Reserve System or something of that effect. But that is alarming in itself, that you can give them $1,000 and they're only required to keep $30 of it on hand. But that was the way it was. Since COVID-19 hit, the Federal Reserve has removed that requirement at all. So now you go and you put your $1,000 in the bank isn't required to keep any, literally 0%. So that's a risk, obviously. So another risk that would be physical security. You can get robbed, right? I have $100 in my wallet. I walk down the street, somebody knocks me in the head and takes my money. That's a risk. Another risk, a larger risk, is that cash is a fiat currency. It's not tied to anything. If you read your dollar bill notes, it says that it's good for public and private debts and is guaranteed by the promise of the federal government to pay that debt. But as we all know, when push comes to shove, it's not based on anything, and those promises are pretty weak. The next vehicle related to cash are money market type securities. In this category, you'll find things like CDs or certificates of deposit or money market funds. So the advantages of these vehicles are they are still somewhat liquid. They are better than cash in the sense that they actually provide you a small yield or a small return on your money. But on the downside, they're still cash-based, they're still fiat currency, and they have inflationary risks as well. The next category is bonds. Bonds come in many different shapes and forms. You have treasury bonds, corporate bonds, municipal bonds. One of the advantages of bonds is many of them have tax advantages associated with them. You'll provide a little bit better yield than you would in money markets type securities, but the disadvantage of bonds are they're not great yields, so you're not going to make a lot of money in bonds. Another risk for those are default risk, and a lot of people would invest in bonds thinking, well, what is the default risk? You're talking about investing in a government or a municipality or a company, but companies go bankrupt. And by the way, municipalities go bankrupt as well. Chicago, for instance. So people investing in bonds in Chicago have been defaulted on because Chicago went bankrupt. Another vehicle that's familiar to everyone is equities. And by equities, we mean stocks, mutual funds, ETFs, hedge funds, those type of investments. The advantage of those, obviously, is they offer much higher yields than the other vehicles do. They're very liquid because their markets are heavily traded and widely held. And so everyone is kind of familiar with those. But they bring their own set of risk with them as well. So one of the things about equity markets are they're volatile. Also, one of the things that people don't always think about, but is absolutely true, is there's a default risk with those as well. Have you ever heard of companies called Enron or WorldCom? If you're a stockholder and the underlying company goes bankrupt, you pretty much get nothing. So there's no risk, there's a risk involved with that as well. Now, when we talk about derivatives, that's a highly complicated conversation, and we could spend an hour video going into all the nooks and crannies of the derivatives markets. But for this video, I just kind of want to hit the highlights. So when we're talking about derivatives, the root word is derived, so it is based on something else. So your derivatives are going to be stock derivatives or currency derivatives or those type of things. We're talking about options, we're talking about futures contracts. So one of the nice things about derivatives is you can limit your risk up front. If I buy an option, I know that my risk is limited to X number of dollars, which is the cost of that option. If it goes all the way to zero, I'm only going to lose the amount of money that I invested. That's certainly a positive. As well, the yields on derivatives are exponentially higher than they are in the other vehicles because they're leveraged. So that's a positive thing. On the negative side, or the risk side, derivatives are extremely volatile. They are subject to manipulation. They have expiration dates. So there's a lot of other mathematical factors that go into the calculation of derivative values. And in order to understand those, you have to do a lot of learning. Another common vehicle is real estate. And the interesting thing about real estate is there are hundreds of different ways you can use real estate as a vehicle. So there's residential, there's commercial, there are REITs, which are real estate investment trusts, so that you can actually own shares in corporate purchases of real estate developments. So there are a lot of ways that you can approach the real estate market. And of course, real estate has a lot of advantages. There are tax advantages to owning real estate. There are the ability to earn passive income off of real estate investments. So there are a lot of things that are positive in the real estate column, but real estate has its own set of risk as well. So obviously there are market risks. People, you would think, buy a house assuming that it's always going to go up in value, but those values change over time as well. Another risk that was made painfully clear over the last 2 years through this COVID thing is the regulatory risk that's associated with the passive income off of real estate. For instance, you are drawing rents, but with the COVID thing, the government basically came in and said landlords are not allowed to evict their tenants if they stop paying rent. That's a huge risk that nobody ever anticipated. So even real estate has its own risk associated with it. Another category is hard assets. And when we say hard assets, we mean things like collectibles, physical gold, like gold bullion, art, collecting cars. Those are all hard assets. Hard assets increase in value, so it's a good place to store value. They don't usually go to zero. But they're physical, so you have to be able to store them. They're not particularly liquid because in order to sell your car or your Beanie Baby or whatever you've invested in, you have to have a buyer. So you can't readily just go down to Walmart and exchange that for groceries. But that's another place that somebody could look to store some value. Another category that's not as popular these days as it has been in centuries past is contribution assets. And by contribution assets, we're talking about pension funds, annuities, those type of things. There aren't a lot of people offering pensions these days, but pensions do exist. And people have always considered those to be safe. Well, I've worked for GM for 50 years, and so I've got a GM pension. But when those companies go bankrupt, those pensions aren't worth anything. There's nothing in those. They get halved or cut through the bankruptcy process. So pensions in themselves aren't safe. And you could say, well, but I work for the federal government or I work for a state government and those pensions are safe. But as we have seen through the financial crisis, municipalities and states go bankrupt as well. California is about bankrupt now, and anybody that's a teacher or a firefighter that has their pensions tied up in those state funds, they can lose their money as well when the state goes bankrupt. The last asset class that we want to talk about, and the point of this video, is cryptocurrency. So cryptocurrency is different from other asset classes in some ways, but they have their risk as well. So on the advantage side, it's not fiat. It's finite. There are only so many Bitcoin, there are only so many ADA, there are only so many Ethereum coins that will ever be produced. So it's not this ongoing thing like where the US government is just printing more and more and more dollars. There's a finite number, which is a good thing. It's decentralized. It's portable, unlike having physical gold where I can have to figure out how I'm going to move my gold from one place to another. You can put it in your pocket in a hardware wallet and take it to Ecuador if you want to. So those are all good things. But it has its own risk as well. Obviously, the markets are very volatile. The price fluctuations are enormous and can be enormous, and it can be scary. But I think right now the biggest risk for it, and one of the reasons that maybe you're watching this video, is it's unfamiliar. It's a new thing and a lot of people don't understand it. And there is certainly risk involved with that, especially on the government side. They don't understand it, and so there's regulatory risk because they don't fully grasp what cryptocurrency is. We've covered a lot of asset classes, and as you can see, there is a large selection to choose from. Each one has its own advantages and disadvantages, and whichever one you choose for your own personal portfolio is going to depend on your circumstances. We ask you to seek the advice of a professional financial advisor, preferably one that is familiar with cryptocurrency, because we believe cryptocurrency should be a part of everyone's portfolio in some way, shape, or form. If you're younger, obviously a heavier weighting than if you're older. But as always, we are advocates of cryptocurrency here on this channel. We ask that you would like and subscribe us, help the channel out and help us grow. And of course, always, if you have your ADA and need to stake it somewhere, we would ask that you stake it with us at GALT1, G-A-L-T 1, and get a return on your ADA as well as helping our channel grow. Thank y'all. We'll see you again here on The Grasp.